The long-awaited inflation report has been released. The crucial data for the US economy instantly crashed the benchmark stock indexes, which tried to gain ground yesterday despite the overall pessimism. And InstaForex analysts can help you figure out ongoing developments and prospects. Before we discuss the robust sell-off of risky assets, let me remind you that Wall Street tried to recover intraday on a Wednesday, but the indexes closed in the red because the Fed's minutes confirmed the central bank's determination to tame inflation. Despite the Fed's hawkish minutes, the major stock indexes closed with minor losses. The Dow Jones slipped 28 points or 0.1%. The Nasdaq dropped 0.9% and the S&P 500 incurred the most losses, having shed 0.33% to close at 3,577 points. The pre-market looked promising today. Despite fragile gains, Wall Street was badly bruised. Shortly after the US CPI report, all three top indexes took a nosedive. They could worsen the free fall intraday. Despite some causes for optimism, the S&P 500 is expected to trade in the intraday corridor between 3,420 and 3,560 points. The index is likely to print a fresh two-year low. The culprit for pessimism among stock investors is the Fed and its minutes. The document reads that the central bank does not see any signs of a notable slowdown in inflation. The FOMC found it appropriate to go ahead with its monetary tightening to fulfill the mandate aimed at a full employment and price stability. However, some policymakers pointed out that the pace of further rate hikes should be calibrated to decrease risks of grave consequences to the economy. The highlight of the day is certainly the US CPI report for September. Until now, the tools of the Fed's liquidity have not revealed any signs of a market crisis. Investors expected the Fed to raise the key interest rate by another 75 basis points at the nearest meeting in November, and the Fed funds futures suggested the probability of more than 90% for this move, and the chance of a rate hike by a percentage point was measured at 10%. Now, investors are revising their forecast not in favor of 75 basis points. The red-hot inflation data did not coincide with the consensus and proved strong inflationary pressure. The core CPI, excluding volatile energy and food prices, jumped to 6.6% on a year in September, at the fastest pace since 1982, following a 6.3% increase a month ago. The actual reading was higher than the expected 6.5%. The core CPI also grew 0.6% in months, at the same pace as in August. It's also an uptick higher than the consensus of 0.5%. At the same time, the annual pace of the US CPI eased to 8.2% for the third month in a row, following an 8.3% growth in August. It's the lowest score in the last 7 months, though higher than the consensus of 8.1%. Despite some signs of easing inflationary pressure, it's not enough to soften monetary tightening, and Wall Street indexes immediately plunged to 2% on average in a light of the statistics. It suggests a volatile session for sure, if not a massive sell-off. The stocks of companies with a mega capitalization such as Apple, Tesla, Microsoft, Amazon and Meta also went steeply down. On the plus side, BlackRock shares showed a modest rise intraday after the company reported lower than expected decline in quarterly corporate profits. The company's assets shrank 16% on year to $7.96 billion in the third quarter. The revised realized profit dropped 16% to $9.55 per share. The turmoil in the stock market benefits the US dollar. Its index is extending a climb. The outlook is bullish. The index is likely to halt in the intraday corridor between 113.30 and 114.60. The CPI for Germany stood at 10.9% in annual terms, in line with the expectations. Thus, the European central banks came up with extremely hawkish remarks at the IMF summit in Washington. This provided some intraday support to greenback's rivals, but the US dollar asserted its superiority in the early New York trade. To sum up, the Fed's minutes and the fresh US inflation data cement market expectations of a further sharp rate hikes. Besides, recession fears also propelled the US dollar to the highest levels of the year. The CPI data certainly outlined a weekly update on unemployment claims, which again printed an increase. The number of first-time jobless claims rose by 9,000 to 228,000 last week, the highest level in 6 weeks. The actual growth exceeded the forecast of 225,000, and it indicates some deterioration in the labor market. This data will hardly quell panic selling on Wall Street. The inflation panic is bearish for the Canadian dollar. The loonie has been already beaten by falling oil prices and the strong US dollar. The Canadian dollar has no driving forces for resilience. The USD CAD pace is trading firmly higher. The intraday corridor for the pair is seen between 1.3890 and 1.1400. Apart from the strong US dollar, the loonie is hurt by other factors such as the hawkish Fed forecast of a global recession, weakening energy demand, and the standoff between the US and OPEC. Yesterday, the International Energy Agency added fuel to the fire. It stated that the decision made by the cartel and its allies to cut oil output set the stage for high oil prices, which in turn could push the global economy into recession. The commodity market responded to the report with a 1.2% drop in oil prices. Today, oil prices have moderated the pace of a decline. Brent crude futures dipped 0.4% to trade at $92.08 a barrel. WRI futures and the WTI futures fell 0.68% to trade at $86.67 a barrel. The crypto market offers assets at bargain prices today. Following the CPI report, cryptocurrencies gave up any hope for recovery. By the moment of recording this video, Bitcoin had tumbled 3.85% to $13,423. Other altcoins are trading sharply lower in sync. Ethereum plunged 5.9% to trade at $1,222. Solana, Ripple and Litecoin shed from 4.2 to 7.6%. The outlook for Bitcoin is gloomy, and the token could test support at 18,200. Then the crypto could either rebound to 18,400 or drop to $17,600. Here is the market review and intraday forecast by InstaForex analysts. One thing is certain: the American session is set to be bearish for Wall Street. Make prudent trading decisions with InstaForex, and see you tomorrow.